Welcome to Quick Invest Brief. In today's Quick Invest Brief, we're diving into the absolute basics of investing, what it is, why it matters, and how you can start growing your wealth with confidence. Our goal is to give you the powerful insights, briefly told, that you need to navigate the exciting world of financial growth. Let's get started. So, what is investing? At its core, it's about putting your money to work for you. Instead of just letting it sit idle, you're placing it into assets with the expectation that they'll increase in value over time, helping your money grow. Think of it like planting a tree. You nurture it, and eventually it provides fruit, or, in this case, financial returns. Why invest? Two big reasons. Firstly, to beat inflation. If you just keep your money in a traditional savings account, or worse, under your mattress, it's actually shrinking in value over time. Imagine what $100 could buy you 20 years ago versus what it buys today. That's inflation at work. The cost of living tends to go up year after year, and if your money isn't growing, at least at the rate of inflation, its purchasing power diminishes. So you effectively lose money. Secondly, and perhaps most importantly, to build wealth for your future, whether that's for a down payment on a house, your children's education, or most commonly, a comfortable retirement. Speaking of your future, the single most powerful factor in investing is starting early. It's all about the magic of compound interest. This is when your earnings start earning their own returns, creating a snowball effect. Let's say you invest just $100 a month starting at age 20. With a reasonable average annual return of say 7% by age 65, that consistent $100 a month could grow to over £190,000. Now imagine, your friend starts at age 35, investing the same $100 a month. Even though they invest for 30 years, they would have significantly less because their money had less time to compound. The early bird truly gets the worm in investing, so even small amounts in your youth can lead to substantial wealth down the line. And here's a secret. Enjoying your early life doesn't have to mean breaking the bank. There are countless cheap or free activities to enjoy. Think picnics in the park, hiking, learning new skills online, or creative home cooking. You can have a rich life experience while still prioritizing your financial future without extreme deprivation. Now, where can you put your money? Let's break down some common avenues. When you buy stocks, you're buying a tiny piece of a company. As the company grows and becomes more profitable, the value of your share can increase. Stocks are known for higher potential returns, but also come with higher risk. Think of bonds as lending money to a government or a company. In return, they promise to pay you back with interest over a set period. Bonds are generally considered less risky than stocks and provide more stable, predictable income. ETFs, exchange-traded funds, are like baskets of different investments. They can hold stocks, bonds, or even commodities. They offer diversification, meaning you're not putting all your eggs in one basket, which helps spread out risk. Historically, gold has been seen as a safe haven during economic uncertainty. Other commodities like oil or silver can also be invested in, often to diversify a portfolio or as a hedge against inflation. Investing in property, whether it's your own home or rental properties, can be a powerful wealth builder. This is real estate, and it offers potential for appreciation and rental income, but often requires a larger upfront investment. For younger investors with a higher risk tolerance and longer time horizon, there are also more speculative avenues. This includes the fascinating world of cryptocurrencies. Take Bitcoin, for instance. Many view it not just as a speculative asset, but as an innovative technological leap that could fundamentally reshape the financial system. While highly volatile in its early days, its volatility has shown signs of maturing. Increasingly, major financial institutions and even some central banks are exploring or already incorporating digital assets like Bitcoin into their portfolios, recognizing their growing relevance in the global economy. However, it's crucial to remember that this remains a higher risk investment and should only be approached with capital you can afford to lose. Regardless of where you invest, remember these key principles. Start early. Time is your greatest asset in investing. Compounding works wonders. Diversify. Don't put all your eggs in one basket. Spread your investments across different asset classes. Invest regularly. Consistency beats timing the market. Set up automatic investments if you can. Educate yourself. The more you learn, the more confident you'll become. That's what Quick Invest Brief is all about. Understand your risk tolerance. Everyone is different. Know how much risk you're comfortable with. Long-term mindset. Investing is a marathon, not a sprint. Ride out the short-term fluctuations for long-term gains. And that's your Quick Invest Brief on Investing 101. Don't miss our next brief. Subscribe now to get more powerful insights, briefly told, delivered straight to your feed. Have questions or want to share your view? Leave a comment below.